Like the idea of taking advantage of the explosion in demand for high-speed internet connectivity? Want a yield and dividend growth rate combination that is perfectly in the sweet spot? Looking for a great dividend growth stock that looks extremely undervalued after a 30% drop in pricing? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a global media conglomerate. High-speed internet connectivity. Demand for this is only growing. How about working from home? How about streaming movies? How about watching videos on YouTube? All of this requires that connectivity, which this company provides. And it's raking in more revenue and more profit and paying out a bigger dividend in the process. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity recently came across in shares of Comcast Corporation, which appear to be trading at a significant discount today. Comcast Corporation, stock ticker CMCSA, is a media and entertainment conglomerate with interests in cable, broadcasting, film, streaming, live entertainment, and theme parks. Founded in 1963, Comcast is now a $151 billion by market cap media giant that employs nearly 190,000 people. The company reports operations across 5 segments: cable communications, 53% of fiscal year 2021 revenue, media, 19%, Sky, 16%, studios, 8%, and theme parks, 4%. Cable communications consists of the operations of Comcast Cable. Comcast Cable provides 17.5 million cable video connections, 30 million high-speed internet connections, and 9 million voice services. Media consists of NBC Universal's television and streaming platforms. This includes a variety of cable networks, the NBC Broadcast Network, the Telemundo Broadcast Network, certain television stations, and Peacock. Sky consists of the operations of Sky. Sky is a leading European entertainment company that provides video, broadband, voice, and wireless phone services. It's also a major content producer via Sky News Broadcast Network and Sky Sports Networks. Studio consists of NBC Universal's film and television studio production and distribution operations. Universal Pictures is one of the 5 major U.S. film production studios. Theme parks consists of the worldwide Universal theme parks. Comcast also has other business interests that consist primarily of the operations of Comcast Spectacor, which owns the Philadelphia Flyers and the Wells Fargo Center Arena in Philadelphia, Pennsylvania. Comcast is a perfect example of why you should be paying more attention to long-term business results than short-term stock pricing. If you're only looking at the latter, you'd think Comcast was in real trouble. After all, its stock fell by about 30% in 2022. However, that's a near-term market sentiment issue, not an issue with the actual state of the business. Indeed, Comcast has been growing healthily. This is in spite of the narrative around quote-unquote cord cutting as consumers shed cable TV subscriptions in favor of streaming options. The key to Comcast's growth revolves around broadband. Fiscal year 2021 saw 1.1 million net additions to total customer relationships across cable communications, largely thanks to broadband. This is central to the investment case for Comcast. Reliable, high-speed access to the internet is more important than ever. After all, the streaming content that gets streamed over the, wait for it, internet, and that's part of an overall shift to more data consumption, supercharged by more people working from home. This requires the quote-unquote digital pipes that Comcast owns. See, Comcast is the largest provider of broadband connectivity in the United States. Due to this, Comcast actually retains a lot of consumer spending. It's just that there's a shift in the spending, less cable TV, more broadband. Streaming has definitely accelerated this shift, but streaming isn't necessarily the bane of Comcast. That's because Comcast is becoming a force of their own in streaming. Peacock, which is Comcast's streaming platform that was launched in 2020, recorded 24.5 million monthly active accounts in the US alone at the end of fiscal year 2021. Comcast is already a major player in the disruptive technology affecting their traditional cable television business. Furthermore, Comcast is a lot more than its cable operations. It's a global media and entertainment juggernaut. Thanks to broad diversification and a stranglehold on broadband in the US, Comcast continues to grow its revenue, profit, and dividend year in and year out. To date, the company has increased its dividend for 14 consecutive years. The 10-year dividend growth rate is a brisk 14.2%. However, more recent dividend raises have been in the 8% range. With the payout ratio at only 30% based on trailing 12 months adjusted EPS, the dividend is healthy and in a good position to continue rising by about 8% or so annually. Along with that high single-digit dividend growth, you get the stock's current market-beating yield of 3%. That yield, by the way, is 90 basis points higher than its own 5-year average. I like dividend growth stocks in what I refer to as the sweet spot, a yield of between 2.5% and 3.5% paired with a high single-digit or higher dividend growth rate. Rarely do I see something that's so dead center in the sweet spot. It's really quite remarkable here. Looking at business growth, Comcast increases revenue from $62.6 billion in fiscal year 2012 to $116.4 billion in fiscal year 2021. That's a compound annual growth rate of 7.1%. I like to see at least a mid-single-digit top-line growth rate from a mature business like this. Comcast delivered. Meantime, earnings per share rose from $1.14 to $3.04 over this period, which is a compound annual growth rate of 11.5%. Top-line growth was very good. Bottom-line growth is even better. This perfectly illustrates the difference between the narrative around cable companies and the reality of the actual business results. The narrative is that cord cutting is a trend that is slowly killing these companies. The reality, however, is that there's simply a shift in spending toward higher margin, higher growth broadband offerings. Indeed, margin expansion helped to drive some of this excess bottom line growth. Routine buybacks also helped. Regarding the latter point, Comcast reduced its outstanding share count by approximately 14% over this 10-year period. Looking forward, CFRA believes that Comcast will compound its earnings per share at an annual rate of 10% over the next 3 years. CFRA sees, and I quote, favorable mix shifts to high-margin connectivity businesses as well as growth in high-speed data and business services, unquote. That says it all for me. Comcast is becoming less about cable TV and more about broadband. CFRA further backs up this viewpoint, again, and I quote, we think Comcast's year-to-date results in 2022 have shown a firming recovery path for NBCU's advertising, TV film content, and theme parks businesses benefiting from pent-up demand. Meanwhile, with the cable broadband business recently riding some demand tailwinds, the company has increasingly pivoted to a broadband-led connectivity strategy and gained significant traction in its nascent wireless offering, unquote. Unless you believe that society will demand less broadband connectivity in the future, it's hard to bet against Comcast. After all, the company often runs local monopolies, being the only major company offering broadband in many of its markets. Rising demand, limited supply. That's a recipe for making a lot of money, and I think it's a recipe that Comcast will be using to continue increasing the dividend annually in that 8% range, supported by this anticipated 10% compound annual growth rate in EPS over the near term. When you're already starting off with a 3% yield, that's an awfully compelling total package. Moving over to the balance sheet, Comcast has a so-so financial position. The long-term debt-to-equity ratio is 1.0, while the interest coverage ratio is above 5. This is an asset-heavy, capital-intensive business model, which explains the balance sheet. I see the indebted nature of Comcast as one of its biggest weaknesses. Profitability, however, is robust, and it's been improving. Over the last 5 years, the firm has averaged annual net margin of 14.3% and annual return on equity of 19.2%. To circle back around to the point I made earlier on margin expansion, Comcast was routinely printing net margin in the 10% area 10 years ago. Fundamentally speaking, despite the narrative around the death of cable companies, this is actually a great business. Other than the chink in the armor that is the debt load, Comcast is running an impressive operation. And with economies of scale, high barriers to entry, and the ability to operate as a local monopoly in many markets, the business does feature durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. While the industry at large is fiercely competitive, Comcast benefits from often being the only major player in any given market. I'd argue that the consternation over the cord-cutting trend is exaggerated when looking at the totality of operations, but cable video disconnections disproportionately harm the company because of a double whammy. This hurts both the distribution side through cable video of the business and the production side through cable networks of the business. Comcast also faces technological obsolescence risk, with competitors constantly trying to bring better, cheaper, and/or faster options to market, e.g. 5G wireless and LEO satellites. The indebtedness limits the company's future flexibility in terms of M&A and network buildouts. Comcast also has a poor reputation for customer service. I think these risks are worthy of being carefully weighed over, but the weight of the valuation should also be considered. With the stock down about 30% from its 52-week high, the valuation looks about as attractive as it ever has. The price-earnings ratio is 10.2 based on trailing 12 months adjusted EPS. That's obscenely low for this kind of growth rate. That puts the forward PEG ratio at almost exactly 1 based on CFRA's near-term earnings per share compound annual growth rate number. The price to cash flow ratio, which is an extremely low 5.9, is also well off of its own 5-year average of 7.8, and the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. That dividend growth rate is at the high end of what I allow for, but I'm not sure why Comcast wouldn't deserve it. The company has been raising the dividend at a much higher rate than this over the last decade. Even the most recent dividend raise came in at 8% on the nose, and the payout ratio is still quite low. With earnings per share growth expected to come in higher than this number over the foreseeable future, it seems very likely to me that Comcast will have the wherewithal to continue increasing the dividend at the level it's been committed to. The dividend discount model analysis gives me a fair value of $58.32. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates CMCSA as a 5-star stock with a fair value estimate of $60. CFRA rates CMCSA as a 4-star buy with a 12-month target price of $50. I came out closer to where Morningstar is at on this one, but we all see severe undervaluation here. Averaging the three numbers out gives us a final valuation of $56.11, which would indicate the stock is possibly 53% undervalued. Here's the bottom line, guys. Comcast Corporation is running a great business despite the narrative around the death of cable companies. Demand for high-speed internet connectivity is still very high, which bodes well for the company. With a market-beating yield, a double-digit long-term dividend growth rate, a low payout ratio, more than 10 consecutive years of dividend increases, and the potential that shares are 53% undervalued, Comcast appears to be an exceptional deal for long-term dividend growth investors. And now for a special news announcement. Domino's Pizza Inc., stock ticker DPZ, was just picked out as one of Bank of America's top 10 U.S. stock ideas for the first quarter. B of A points to easy laps and a relatively attractive valuation. What can I say? Great minds think alike. I already picked Domino's as one of my top 5 ideas for all of 2023. Some think a recession is coming. Maybe, maybe not. Either way, people aren't going to stop eating pizza. Domino's should be top of mind, especially in this environment. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It'll allow me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.